Wealth after 50 presents. What the heck does breaking the buck mean? Imagine a piggy bank that came with a guarantee. For every dollar you put in, you get $1 back. Now what if you woke up one morning and found it cracked, only giving you back 97 cents? That tiny 3-cent gap back in September 2008 didn't just cause a problem. It nearly froze the entire global financial system overnight. Today, you're going to find out why that's called breaking the buck, how it almost crashed the world economy, and what's still keeping regulators up at night. Money market funds are often pitched as being almost as safe as cash. You park $1, you get back a share worth exactly $1 plus a tiny bit of interest. These funds invest in super safe short-term stuff, like government IOUs and debt from top-tier companies that gets paid back in days, not decades. They use accounting to keep the share price locked at $1. Your statement always looks steady, just like a savings account. No drama, no surprises, no homework needed. Wall Street even called these funds the buck because the idea of them ever breaking that $1 promise was thought to be impossible. But even the safest funds are in a race to offer the best return. To beat a competitor by just a fraction of a percent, some fund managers started reaching for slightly riskier investments, like the short-term debt of a legendary investment bank called Lehman Brothers. By the middle of 2008, the industry was holding $3.5 trillion. The Reserve Primary Fund, the oldest of its kind, had about $785 million of Lehman's debt. So when Lehman Brothers declared bankruptcy on September 15th, that debt was suddenly worthless. The fund's own math showed that each $1 share was now only worth 97 cents. 3 cents might sound like nothing, but not when you're managing billions and your investors are expecting absolute safety. Within hours, corporations, pension funds, and regular savers all started hitting the redeem button at once. The fund got $20 billion in withdrawal requests before lunchtime. By the next morning, $60 billion was trying to get out. There's a name for this: a run on the buck. When the unbreakable piggy bank shatters, everyone wants their money out first. This forces funds to sell even their good investments into a market that's already panicking. Interest rates shot up, short-term lending completely dried up, and for about 48 hours, the plumbing of modern finance was totally clogged. So why did regulators freak out? Because money market funds are the ones buying the short-term IOUs that companies depend on to make payroll and keep the lights on. If these funds suddenly stop buying that debt, grocery stores can't pay their suppliers and cities can't pay their employees. The U.S. Treasury had to step in and guarantee every fund that participated, protecting $3 trillion. The Federal Reserve launched something called the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility, just to buy up all the debt nobody wanted anymore. All in, the emergency backstops were over $400 billion. Without that intervention, Fed analysts later admitted that unemployment in 2009 could have soared past 15%. After the crisis, Washington rewrote the rules. Now, funds have to keep 10% of their money in assets they can turn into cash within a single day and 30% within a week. They also have to report how much cash they have on hand every week. For the big institutional funds, the SEC got rid of the sacred $1 fixed price. Their shares now float with the market, so investors see tiny price wiggles every day. Regular retail funds, however, still get to stick to the $1 price, but they face much stricter rules about what they can invest in. Europe has been talking about similar reforms, but some countries are dragging their feet to protect their own massive fund industries. Regulators still worry that another surprise default, say from a major company's short-term debt, could create another 97-cent situation. The good news is that funds have much bigger cash cushions now, and the Fed has a proven plan for what to do in a crisis. The bad news? A sense of moral hazard remains. Many investors still treat these funds like bank accounts, forgetting they don't have the same government-backed insurance. So, you can keep using money market funds for convenience, but you have to remember they're investments, not guaranteed savings accounts. It's smart to spread your money across a few different funds, and if you truly hate surprises, stick to funds that only buy government debt. Most importantly, keep your real emergency cash in an FDIC-insured bank account. And remember, it's never too late to grow your wealth after 50.